Welcome to the Wealth Studying Podcast. This is episode 520. Today is May 13th, 2026. I'm your host, John Pugliano. I also have my son, Joe, with me today. Joe, what are we going to talk about?
Sell in May and go away.
Absolutely. And I think I forgot to say that I'm the founder and money manager at investablewealth.com. That's my big commercial for the episodes I always throw in there. Joe is my tech analyst. He's also fully licensed and helps me with the trading and portfolio management as well. Hey, today we want to talk about sell in May and go away. Like Joe said, that's a popular adage on Wall Street. And I've noticed as of late, it's getting a lot of press. Tom Lee, I believe, is somebody out there that's definitely promoting it, which is unusual because he's pretty much a perma bull. He almost always sees optimistic markets ahead, and he is not at all bearish. He's just saying, hey, he thinks we could get a 10, 15% type correction before the market goes on to, hit, I think his numbers 7,800 or more for the S&P 500 this year. In any case, what about it? Well, sell in May, go away wouldn't be an adage if it wasn't some truth to it, right? It's like, good comedy. For something to be really funny, it has to have at least an element of truth to it. So there's definitely seasonality to the market. You always have to remember, though, that when it comes to these adages or when it comes to press coverage or the talking heads, the more people talk about it, the more it's already priced into the market. And so it has either already happened or it's not going to happen, is a good way to look at things. That takes us back to the most anticipated recession of all time was in 2023. I, as well, was negative in 2023. I thought it was before an election year, and the administration then, the Biden administration, would want to get the recession out of the way. Factor in that and a lot of other global issues. In fact, global growth that year, I think, was under 3%. So I was very negative in 2023. But as it turned out, again, because so many people anticipated a recession, we never got one. I think we could also argue that that really was the birth of the AI momentum that we, excuse me, that we currently see right now. And had it not been for the big leadership we saw in the Mag 7, we probably would have had a major, I'd say at least, correction in 2023 in the stock market, even if we didn't have a recession. Hey, in any case, sell in May and go away. I'm not selling. You will likely see me, though, in the coming days or weeks, maybe trimming my portfolio. And as I've mentioned many times, investing is like a garden. You prune your garden, you harvest your garden. That doesn't mean you dig it all up and don't ever garden again. Especially if you have something like a perennial or a fruit tree or a nut tree where it's just constantly producing, you're going to prune it back. You're going to harvest the fruit off of it. You want to do the same thing with your portfolio. So more than anything, if you see me selling something, it's probably not because I'm in a panic. If I am, I'll tell you. But it's more likely that we're going to be selling because we're simply making adjustments to the portfolio, which is something that I haven't done a major adjustment to in a long time because just things are going very well and I haven't wanted to take profits. But we could be doing that. The thing to watch for and why I think that things are pretty stable right now is because of profitability. And this kind of goes to jobs. Do we have some charts? What do we have from the blog posts? We have a chart on jobs, right?
Yep.
And what was the other chart we had?
Comparing it to the tariff announcement.
Oh, that's it. Yeah, bring that one up. So if you go back, I think that was 2 blog posts ago.
Mm-hmm.
If you go back a couple weeks, 2 or 3 weeks ago, I put up a blog post at investablewealth.com. By the way, if you're subscribed to that, the free notification on that, we don't. People often multiply subscribe to that, and it's just we're not putting out daily or even weekly information. If I don't have anything to say, we don't put anything out there. So if you are subscribed, you're subscribed. You don't have to worry about it. You get the notices. Everything's always archived there, so you can always go back and look at it. But if you go back a couple weeks ago, when I put up the chart, are we showing it?
Well,
I don't see it coming up yet.
trying to.
We're trying to. We are still experiencing technical difficulties with our live YouTube streams, and that's
So this is the new one.
okay.
That's it.
And I hope it's showing up better than what I'm seeing on my end. But I want to go to the cashing in on chaos one.
Mhm.
If you look at that chart where it's superimposed, on my end I don't see it very well. Anyways, if you can see it, or you go over to the blog post, you can see that you could have made the argument last year. Hey, the market had run up after Liberation Day. We had a V-shaped recovery, and you could make the argument, sell in June and go away because they're going to get to a summer lull, and it's seasonality, and the markets always have lower liquidity over the summer, and then of course August, September, October tend to be notorious for the worst times of the year in the market. Yeah, all that's true, but again, what happened last year? If you sold in May or sold in June or sold in August, you missed a huge run-up. I think we could likely see the same thing this year, simply because there's so many good things going on. Profits are coming in at twice the regular rate. In fact, first quarter profits, the last number I saw just I think yesterday was average S&P 500 profit, I believe, is 25% better than last year at this time. That's extraordinary. That's much better than more than twice what we see with profitability. And the estimates have all been raised throughout this year that we're probably going to see 18, 19, 20% year over year growth, which would again be more than twice the regular number. That in and of itself, if it materializes, that in and of itself should keep the rally going. Big reason, and Joe, if you could pull up the other chart from the most recent blog post, which is
Move your mouse.
which is the job number. Joe's telling me to move my mouse here. I guess for the podcast listeners that are hearing this delayed, if you haven't noticed, we're live on YouTube. I don't think I said that at the beginning, but we are now bringing up, hopefully on the screen, you're seeing the most recent blog post that I put out there. And this was a chart from Bloomberg, and it shows a comparison of the percent of tech workers in the general economy, as well as the percent of market cap that tech stocks make up of the S&P 500. And you can see over the last, I think it shows like a 20-year history, tech stocks have now I think something like 80% of market cap. And I'm not seeing a chart on my end, but Joe, if he sees on his end, he might comment. But like 80%, something like 80% of market share on the right-hand side of that chart.
Yeah.
80% of the S&P 500 is tech stock related in terms of market capitalization. That's from maybe like 20% 20 years ago. If you look at the overall jobs number, you'll see that during the pandemic and following the pandemic, there was a huge run up in tech workers that were hired. As of late, in the last 12 months or so, you've heard about a lot of layoffs. But if you look at that chart, we're just back to where we were on the 20-year decline of tech workers, right? And this is proportional. It's not saying that there's less tech workers today than there were 20 years ago. It's saying that their percentage of the overall economy has gone down. So while there are more tech workers, there were also more workers in general. And so that's why the share has gone down. But the point here is that for the last 20 years, every year on a percentage basis, there are less tech workers, even though they make up a larger and larger share of the market capitalization of the economy and of the S&P 500. The point being, the reason we invest in tech stocks is because tech companies are extremely profitable. They're profitable because they reduce their headcount. They are more productive than the average company. And I mean, that's why does Jesse James rob banks? Because that's where the money is. It's the same thing we see with technology companies. And today we have a certain idea of what tech is. Maybe it's artificial intelligence, maybe it's robotics. But remember, over the years and decades and centuries, there's always been a new form of technology. 150 years ago, it was railroads. 100 and some years ago, it was electricity and electrical companies. 60 years ago, it started to be what we consider now tech, being things like computers and software. But by technology's very nature, and this is a point I made in the book I wrote, The Robots Are Coming, is that technology is deflationary. The reason we haven't seen a major collapse, in the US dollar or the economy or all the things people worry about with all the government printing and government debt is that as much as the government has inflated the economy and devalued the dollar over the last 60 years, technology, because it's deflationary, has counteracted that over those same 60 years. And that's why we continue to see growth, is because even though the dollar's devalued, technology makes things less expensive, right? The first computer I ever bought was it was in the year like 1986, 87-ish, around there, probably 1986. That was the most expensive computer system I ever bought, right? It was a black and white dot matrix printer. It was a monochrome orange monitor. The background was more, it was orange and black were the colors on it. The computer itself was an IBM clone. It didn't even have a internal memory. Like everything was just done a floppy disk. And I eventually bought I think it was either a 10 or a 20 megabyte hard drive that I eventually bought for it. And in those days, I thought, man, I'll never fill this up. How could I ever have 10 megabytes of data? Well, it didn't take too long to fill that up, right? But that was the most expensive computer system I've ever purchased. And it did virtually nothing, right? It was a word processor. It did spreadsheets. And back then it was Lotus 1-2-3. We didn't even have PowerPoint or Excel or Word. It wasn't even Word back then. Microsoft, like my word processing was Word Perfect, was the system. So technology reduces variable costs. It's deflationary. And that's why tech companies make so much money. And over the last 60 years or so, as we become more tech-based and more service-oriented type economy, we're more productive, corporations make more money. So sell and man go away? I don't necessarily think so. I think that if these profits hold up, things should work out. Remember, seasonality is like the weather, right? We go through in the temperate climate zones, we have 4 seasons. Just because you're in spring doesn't mean you're not going to get a late frost and come and kill everything, right? Or just because you're in the Indian summer or in the fall doesn't mean you're not going to get an early frost. And it's going to again come out and kill things early for that winter season. Things happen out of cycle. If they didn't, then everything would be predictable. We could predict the future, but we can't. All right, Joe, you let me ramble on and digress for way too long. What questions have come in? What do we have?
Well, it sounds like we had some audio issues.
Again,
Well, we fixed it right away, but then I think when I shared the screen, it
messed it up
messed
again.
it up again. So,
Okay.
but we should have been good for the last little bit. Yeah, someone mentioned that most expensive computer they ever bought was the Apple in 1984.
84. Yeah, I'm pretty sure I bought my system in 86, and it was an IBM clone. It was actually a Commodore. It wasn't the famous Commodore 64, but it was a Commodore branded IBM clone. It was a great computer for what it was. I remember when it came in the mail. There's no internet back then. I ordered it through a catalog, and it shipped in, and I stayed up to like 3 or 4 in the morning. I was so excited, like Christmas Day. As a little kid, I wasn't a kid. I was old, but it was like a little kid with a new toy, and I stayed up all night long loading my software on it, and who knows what I did with it because there wasn't much you could do.
So in the news, a lot about Trump going to China. Curious what your thoughts are on that and what's going to happen there.
We'll wait and see. Listen, I don't believe what any politician says, and you know, God love Donald Trump, the orange tariff bombing tax man, whatever you want to call him. Of all politicians, you can never believe anything that he says because you know. Did I say that? I can't believe I said that. Did I say that? Next question, right? And it's not a hate on Trump. It's just he's the consummate politician. There's no idea. I mean, what he says today isn't necessarily going to be what he says tomorrow. He's with the communist Chinese, so there again, what they say today is who knows what they're going to say tomorrow. I think the big thing the media is missing, though, is that there's a lot of talk about Trump or the U.S. needs China to step in and help with opening the Straits of Hormuz, and so I think that's all nonsense. The Straits of Hormuz, them being closed or blockaded, or minimum oil getting out of there, that hurts the Chinese far more than it hurts certainly just about anybody else, and definitely more than it hurts the U.S. I think the media really misses a lot of things when they see all the chaos that Trump has created, particularly in Iran right now, and they say how the U.S. is being humiliated, or we've created something we can't solve or can't get out of. The chaos, I think, is intentional. Just like the Nord Stream pipeline, when that got blown up, right? Who did it benefit? A lot they came out and blamed Russia initially. Listen, the U.S. benefited more from the Nord Stream pipeline being blown up than anyone. The U.S. definitely benefits from the conflict in Ukraine, which is why I don't think neither Biden nor Trump is anxious to get it solved anytime soon. And likewise, the chaos in Iran, it benefits the U.S. Basically, maybe not more than any other country, but certainly is a huge benefit to us because we are an oil exporter now, and because our Navy is, uh, keeping open the sea lanes. I've said before that the invasion of Ukraine showed Europe that they needed NATO, and the conflict now in Iran and the shutting down the Straits of Hormuz has showed the rest of the world, particularly Asia, how much they need the United States Navy to keep the sea lanes open. So I think the media is off on that with Trump's visit over there. Who knows what they're going to resolve with tariffs? Again, does it really matter? We're more than a year into the whole tariff situation. It's almost off the headlines. No one cares. Tariffs are still in place. It's still a weaponized way of something that Trump uses. And remember, the stuff he put on in his first term was never taken off in Biden's term. If Democrats come in, or whoever comes in 2028, tariffs aren't going away. It's a new weapon. We're beyond the post Cold War, Marshall Plan from World War II, where we opened up our markets and gave allies and anybody else free access. Those days, I think, are long gone.
Kind of still in the political side of things. The Fed chairman is changing out now. It looks like
Warsh, yeah, Warsh was. I think his name is pronounced Warsh. He was just nominated, I think, yesterday.
Yeah, and I think the Senate approved it.
Senate approved. Yeah, yep. Not nominated, but yeah, he was actually approved. Yes.
Is he going to hike rates?
I don't think he's going to. Hey, you've heard that? I haven't heard anybody say this. I forget his first name. His last name is Warsh.
Kevin
Warsh, and I can guarantee that he will be the Warsh Federal Reserve president we've ever had. How's that? Listen, he's supposedly Trump friendly. Don't ever forget, Trump hates supposedly Jay Powell. Well, who nominated Jay Powell? Trump in his first term. So, who knows how this could turn around. Warsh seems to be pretty respectable. He is he's looking at things from almost a Laffer curve perspective. And if you remember, I think it was Arthur Laffer from back in the Reagan days. He was an economist. It said he had a thing called a Laffer curve, which was kind of a parabola-looking graph, And his whole argument was that if you lower taxes, we've got this curve, and his argument was is that we're on this side of the taxes of it, so that um, by raising the tax rates, you're actually collecting less in revenue because people will find ways to not pay taxes because they're so high. If you actually reduce taxes, you move to that side of the curve and you'll actually see tax receipts go up. That happened in the 80s. It happened even with Trump's both of his tax cuts. Kennedy, if you hate Republicans, Kennedy did the same thing in 1961, I think it was. There are times when you can actually cut taxes and get more in tax revenue. Warsh is kind of saying the same thing with interest rates, that interest rates are too high. Again, sort of on that Laffer curve concept, where you could actually reduce interest rates and not make inflation any worse because the economy would grow at a faster rate. Argument seems feasible. Um, I don't think he's going to be able to come in and cut immediately like a lot of people thought, say 6 months ago. Excuse me. And that is because inflation is so high, but inflation is mostly high because number one, the economy is doing so well. And especially, food and energy costs are off the charts because the Straits of Hormuz has either been closed or under attack for over 2 months now. And that's where, at least 20% of the oil supply comes out of. And there's even more there with all the refining and all the petrochemical processing that the Middle East does now. That all runs through there as well. So those are major reasons for inflation. But to the point about would he raise rates, and again, this is all over the media, all the talking heads are saying, oh, they're going to raise rates. I don't see it happening because this is not monetary inflation. This is supply chain or supply scarcity inflation. Federal Reserve can raise rates all they want, and that's not going to make any more oil come out of the ground, right? It's not going to make gasoline any cheaper. The answer to high gasoline prices is more drilling for oil. We're opening up the straits. At some point, they will open the straits. I think that's a point we made a couple episodes ago about, I would short gasoline because at some point they are going to open the straits. It's going to work in everybody's favor when they do that. And the world is awash in oil. Before this whole Iran bombing started at the end of February, the analysts that are telling you now that we're going to see $200 oil, they were telling you then you're going to see $40 oil because there's so much of an oversupply.
One thing I thought was interesting last week, GameStop says they're gonna buy eBay, right? Take over them. And then today, or maybe it was yesterday, eBay came out and said the proposal is neither credible nor attractive. I mean, I don't know. You ever seen where a smaller meme stock company goes and tries to buy a credible growing company?
Yeah, not necessarily a growing one, but I do remember, and this kind of gets back to where people worried about we're in a AI bubble like the .com bubble. This isn't AI related, right? This is just crazy investing related. But I do remember back during the .com bubble, before everything blew up, Yahoo bought Time Warner, who would have been the big media guy. So that would be like GameStop today buying Disney or something, right? Some little startup company with no, they had a lot of revenue, they had no profits. They went out and bought Time Warner. It all fell apart, and there's not even any YouTube around today or Yahoo around today in terms of a company. There's still obviously Yahoo, the website, but the company's been long absorbed into other things. So I think it's kind of comparable to that. Um, it's all nonsense. It's like when AMC a couple of years ago went out and bought a gold mine. These companies, whether they're special purpose acquisition companies or whether they're just a company that has a glamorous or an influencer type billionaire or CEO, they can go out on Reddit or these different forums, attract an audience. They can get enough money to make these crazy things happen. It distorts the market, but then what happens? They fall apart. I mean, Beyond Meat, remember that one? That was going to go to the moon and change the world. A bunch of people jumped on that, 3-4 years ago, and I don't know, what are they trading for, $1 now, or maybe not even $1 anymore?
Yeah, around there.
Probably was a $300 stock at one time. I I am shocked the GameStop hasn't gone out of business a long time ago. I can remember when they first shot up during the pandemic. Um, People were asking me if I was going to short it, and I said, "Yeah, that's the best short in the world." Well, shoot, they're still around, so who knows? I mean, it's ridiculous, and it just goes to show you, though, right? I love this country. There's so many ways to make money, um, where people go out and have these crazy ideas, and at least short term, there's a lot of money that can be made in the trade. You won't see me buying it, but I do like eBay, by the way. I can't stand GameStop, but I think eBay is a very viable company. We've uh, we've seen some ramblings about possibly them getting into things like live auctions and using more influencers to drive their sales and to really take advantage of the platform that they have. And I think eBay as a company is interesting, but man, I would stay far away of it until this GameStop thing is resolved. My personal opinion, not giving any financial advice. What else do we have, Joe?
That's all we got for now.
Okay, and we had a question from last week we didn't answer.
Yeah, last week they asked, what's your reasoning for getting in and out of positions?
Yeah,
What do you live by? I think.
Yeah, what rule do you live by or something? I've been investing for over 40 years, and I guess the biggest rule that I have is not to have any rules, other than you got to trade the market you're in, right? Every market is different, and this gets back to why I say no one can predict the future, not artificial intelligence, not anybody, not anything. And if you could, and this kind of gets back to those Back to the Future type movies, if you could go back in time and you change something, it would change the future. So then how could you even have been going back in time because you did something that affected the future? If anybody could predict the future by the very nature of being able to predict it, they would change it. So the future wouldn't be predictable. Now, when it comes to investing rules that you have to live by, again, they change, right? If you go by what Warren Buffett said 30 years ago, a lot of it doesn't apply today, even though what he said then made sense. And he's obviously been a great investor. But pick up any old book on investing, and other than broad rules of wealth building, yeah, I agree with those kind of things. But in terms of actual mechanisms of trading the markets, Peter Lynch used to say, if you pay more than um, one times PE, or, if you buy anything more than a one PEG, uh, you're overpaying for a stock. Well, you'd be hard pressed nowadays to find anything that's at a one PEG. It just doesn't happen, right? Or um, William O'Neill from Investors Business Daily. Read all of his books. I love him. I respect him, but he just says a lot of goofy things that don't apply anymore. One of their things about checking a breakout, it's like if it goes up a dime, or if it goes up 10% from the supposed level you're tracking, then that's a breakout. But really, like a 10% move on Bookings Holdings, which is like a $6,000 stock, like you couldn't even, a 10-cent move isn't even relevant, right? You wouldn't even be able to catch that in the static or the noise. So I think the best rule is just to trade the market you're in. I would have told you 5 years ago, if you're just an investor, or a new investor that's more of a saver, and you're just starting to get into investing, you don't have a lot of money, just dollar cost average into the S&P 500. Go out and buy SPY. I told people that for a decade. Well, I don't say that anymore, because I think the traditional S&P 500, or an ETF that tracks it like SPY, is too concentrated in a dozen or less stocks. And it isn't that isn't a good investment. It's just that the whole reason you invest in the S&P 500 is for broad diversification. And if it's all focused in 12 stocks, well, it's not diversified anymore. So now I would say, go out and buy something like RSP instead of SPY. Things change. They always change. They always will. And That's why we'll be back for our next episode. You got anything else, Joe?
Nope.
All right. So, hey, until next time, as always, best returns.